Imagine an airline that has it all. The coveted 5-star rating, placing it in an elite club with Singapore Airlines and Qatar Airways. A fleet of brand new, state-of-the-art jets. A cabin crew voted the world's best, year after year. This was Garuda Indonesia in the mid-2010s, the pride of a rising nation. Now imagine that same airline is technically bankrupt, drowning in billions of dollars of debt. Its former CEOs are in jail for corruption. A huge portion of its fleet is grounded, not by a pandemic, but because it can't even afford the spare parts to fix them. This is also Garuda Indonesia. So what happened? How does a national flag carrier, a symbol of immense pride and ambition, become a case study in perpetual crisis? This is the story of the endless struggle of Garuda Indonesia, a cycle of spectacular comebacks and even more spectacular collapses, and the story of a nation that simply refuses to let it die. To understand this paradox, we need to go back to a moment of boundless optimism, an ambitious plan called the Quantum Leap. We'll uncover the deep-seated corruption that rotted the airline from the inside out. We'll break down the Great Reset of 2022, a massive $9 billion debt restructuring that was supposed to fix everything. And we'll see how that fix led directly to the crisis of today, culminating in a last-ditch $500 million lifeline from Indonesia's new sovereign wealth fund. This is the Garuda saga. Our story begins in 2009. Fresh off the lifting of a European Union flight ban that had crippled its international ambitions, Garuda Indonesia launched a bold 5-year transformation plan, the Quantum Leap. The goal was simple but audacious: to transform the airline into one of the world's best, a symbol of a modern and rising Indonesia. This wasn't just about buying new planes. It was a complete identity overhaul. The plan called for a new brand, a fresh livery, modern uniforms, and a renewed focus on premium international service. But the centerpiece of this ambition was a massive, debt-fueled shopping spree for new aircraft. The airline placed a flurry of orders with both Airbus and Boeing. It ordered dozens of new Boeing 737-800NGs to modernize its domestic and regional workhorse fleet. For medium-haul routes to Asia and Australia, it looked to the Airbus A330. And for the most prestigious long-haul routes to Europe, it placed an order for the flagship Boeing 777-300ER, complete with a new first-class cabin and onboard chefs. The scale of the expansion was breathtaking. The Quantum Leap program aimed to nearly double the airline's fleet, from just 62 aircraft in 2009 to 116 by 2014. The ambition didn't stop there. Internal plans projected a fleet of 194 aircraft. By 2015, this growth was meant to fuel a surge in passenger numbers, from 10.1 million in 2009 to a target of over 27 million by 2014. And for a while, the strategy seemed to be a spectacular success. The airline triumphantly resumed flights to Europe, launching service to Amsterdam in 2010 and later extending it to London. It expanded its network across Asia and Australia, establishing new hubs to improve connectivity throughout the vast Indonesian archipelago. In March 2014, it cemented its global status by joining the SkyTeam Airline Alliance, partnering with giants like Delta and Air France-KLM. The crowning achievement came in December 2014. Skytrax, the industry's leading rating agency, awarded Garuda Indonesia its highest honor, a 5-star airline rating. This placed Garuda in an exclusive club of just 7 carriers at the time, alongside legends like Singapore Airlines, Cathay Pacific, and Qatar Airways. On paper, the Quantum Leap had delivered on its promise. Garuda was, officially, one of the best airlines in the world. But this glittering success was built on a fragile foundation of debt. The Quantum Leap was incredibly expensive. The fleet expansion continued relentlessly. At the 2015 Paris Air Show, Garuda announced its intent to order another 90 aircraft, a deal worth a staggering $20 billion at list prices. To finance this, the airline went public with an IPO on the Indonesia Stock Exchange in 2011, but the government retained majority control, underscoring its status as a state-owned enterprise. The financial results told a story that was starkly different from the public image of success. While revenues were growing, propelled by the expanding fleet and network, the bottom line was dangerously volatile. After a peak in 2012, when the airline posted a healthy net profit of around $110 million, the numbers began to slide precipitously. Then, in 2014, the very same year it was crowned a five-star airline, the house of cards came crashing down. The company recorded a shocking net loss of $372 million. The pursuit of prestige had come at a ruinous cost. The quantum leap had propelled the airline to the heights of industry recognition, but it had also flown it straight to the edge of a financial cliff. The dream had become a fiscal nightmare. The core conflict of this era is laid bare by the numbers. The airline was successfully chasing vanity metrics, a larger fleet, more routes, and prestigious awards, while its financial core was rotting away. The quantum leap was never just a business strategy. It was an exercise in nation branding, a common practice for flag carriers in emerging economies. For a rising Indonesia, having a five-star airline was a powerful symbol on the world stage. The focus on a new brand, new uniforms, and joining a global alliance reveals a preoccupation with prestige, not profit. As a state-owned enterprise, SOE, Garuda was acting as a diplomatic and cultural arm of the state, projecting an image of a modern, capable nation. This meant that financial unsustainability was baked into the plan from the very beginning. The strategy created a structurally high-cost airline, bloated with expensive new aircraft and unprofitable, flag-planting international routes. This made it extremely vulnerable to the slightest external shock, such as a spike in fuel prices or a depreciation of the Indonesian rupiah. Factors that the airline itself later blamed for its poor performance. The quantum leap didn't just fail, it was designed to fail, establishing the first major turn in Garuda's endless cycle of crisis. While Garuda's finances were crumbling under the weight of its own ambition, a deeper, more corrosive problem was eating away at its core, a culture of systemic corruption. This wasn't just about skimming money off the top. It was about decisions that would strategically sabotage the airline for a decade to come. Nothing exemplifies this more than the case of Emilsia Sattar, who served as CEO from 2005 to 2014. During his tenure, Sattar presided over a series of procurement deals tainted by bribery and kickbacks. The most damaging of these involved the acquisition of Bombardier CRJ-1000 regional jets and ATR 72-600 turboprops. These weren't just bad deals. They were fundamentally the wrong planes for the airline. The Bombardier CRJ-1000, a 96-seat jet, was a notoriously poor fit for Garuda's domestic network. Its limited baggage capacity was ill-suited for the Indonesian market, where passengers often travel with more luggage, and its operational economics were inefficient on the short routes it was assigned to fly. The airline lost a reported $30 million per year, just from operating the CRJ-1000 fleet. But the planes were acquired anyway. Investigations later revealed a complex web of corruption involving bribes from manufacturers like Airbus, Rolls-Royce, Bombardier, and ATR to secure the deals. Sattar was found to have unilaterally altered the airline's fleet plan, changing the requirement from a 70-seat aircraft to a 90-seat one without board approval, a move that favored the Bombardier jet. The total cost to the Indonesian state from these corrupt procurement deals was estimated at a staggering $609 million. The culture of corruption and impunity did not end with Sattar's departure. In December 2019, his successor, CEO I Gusti Ngurah Askara Danadiputra, known as Ari Askara, was caught red-handed in an act of almost comical brazenness. Askara, used the delivery flight of a brand new Airbus A330-900 Neo from Toulouse, France, to smuggle personal luxury goods into Indonesia. Hidden in the cargo hold were a disassembled classic Harley-Davidson motorcycle and two high-end Brompton folding bicycles, all intended to evade Indonesia's steep import taxes. The act itself was a blatant abuse of power, but the details revealed a deep-seated culture of entitlement. The purchase of the motorcycle was made months earlier through a bank transfer to the account of a Garuda finance manager in Amsterdam. The illicit cargo was then deliberately left off the flight manifest, and other directors and their wives were reportedly on what was supposed to be a skeleton crew ferry flight. The smuggling attempt was discovered by customs officials upon the plane's arrival in Jakarta. The Minister of State-Owned Enterprises, Erick Thohir, a key figure who will reappear in our story, promptly fired Askara. The incident, while small in financial terms compared to the Satar-era scandals, was a powerful and embarrassing symbol. It showed the world that the rot within Garuda went far beyond simple mismanagement. It was a problem of deep-seated systemic corruption at the very highest levels. The real damage from this era of corruption wasn't just the money lost to bribes or the public humiliation. It was the strategic poison pill injected directly into the airline's operations. The decision to acquire unsuitable aircraft like the CRJ-1000 saddled Garuda with a fleet that was structurally unprofitable. These planes were a permanent drag on the balance sheet, a cancer that made any genuine turnaround effort nearly impossible. This creates a direct and powerful link between the events of the early 2010 and the crisis of the 2020. When we look ahead to the massive 2022 restructuring, one of the most critical decisions made was to finally get rid of these toxic assets. The entire fleet of 18 Bombardier CRJ-1000s and the mainline's ATRs were returned to lessors, a painful and costly admission that the planes should never have been acquired in the first place. The Great Reset of 2022 can therefore be seen not just as a financial cleanup, but as a decade-late surgery to remove the tumors implanted by the corruption of the Satar era. By the time the COVID-19 pandemic swept across the globe in 2020, Garuda Indonesia was already on life support, weighed down by the legacy of its debt-fueled expansion and endemic corruption. The complete shutdown of global travel was the final, devastating blow. With revenues evaporating overnight, the airline's financial situation became catastrophic. It defaulted on a $500 million Islamic bond, a clear signal of its insolvency. Its total liabilities, including massive payments owed to aircraft lessors, ballooned to an almost unbelievable $9.8 billion, with some creditor claims pushing the total figure as high as $13.8 billion. The airline was, for all practical purposes, bankrupt. To avoid a complete liquidation and the disappearance of the national flag carrier, the Indonesian government took drastic action. In December 2021, Garuda officially entered a court-supervised debt restructuring process, known in Indonesia as PKPU, which stands for Penundaan Kewajiban Pembayaran Utang. Think of PKPU as Indonesia's equivalent of Chapter 11 bankruptcy in the United States. The court grants a temporary suspension of all debt payment obligations, putting a freeze on creditor claims and giving the company critical breathing room to negotiate a comprehensive restructuring plan. This was a monumental task, involving negotiations with 470 different creditors, ranging from giant international aircraft lessors and manufacturers like Boeing and Airbus, to state-owned banks and small local suppliers. The negotiations were tense and complex. Garuda's proposal was radical. It asked its creditors to accept a massive haircut, essentially writing off a huge portion of what they were owed. The goal was to reduce the airline's crippling liabilities from nearly $10 billion to a more manageable $3.7 billion. In June 2022, after months of back and forth, the plan was put to a vote. In a stunning victory for the airline, an overwhelming majority of creditors, over 95% by value, approved the restructuring proposal. The deal was a masterclass in financial engineering. Garuda's total debt was slashed by more than 50%, from $9.8 billion down to approximately $4.6 billion after the process concluded. This was achieved through several mechanisms. A large portion of the debt was simply forgiven. The remaining obligations were converted into new financial instruments. $825 million in new 9-year bonds and $330 million in new company shares, effectively turning some creditors into shareholders. Loans from state-owned lenders were restructured into new 22-year loans with an ultra-low 0.1% interest rate. But the most visible and brutal part of the reset was the downsizing of the fleet. The airline that had once dreamed of operating nearly 200 planes was forced into a dramatic contraction. The total Garuda Group fleet, including its subsidiary CityLink, was cut from 210 aircraft in 2020 to just 134 by the end of 2022. The plan for the mainline Garuda carrier was even more stark: to operate a core fleet of only around 61 to 66 aircraft going forward. This fleet reduction provided a stark, at-a-glance visualization of the restructuring's severity. It was not just a simple reduction, it was a strategic amputation, most notably targeting the aircraft acquired through the corrupt deals of the past. However, the very process that saved Garuda from financial collapse planted the seeds of its next operational failure. The PKPU restructuring was a short-term financial fix that created a long-term, insidious vulnerability. To convince creditors to accept such a massive write-down, the airline had to present a business plan centered on extreme and immediate cost-cutting. This meant slashing budgets across every single department, including the critical areas of maintenance, engineering, and spare parts inventory. This financial starvation of the operational side of the business was a predictable consequence of a brutal finance-first restructuring. Post-restructuring, suppliers, having been burned before, grew wary. Reports emerged that MRO providers and parts suppliers were now demanding cash up front for their services, a standard practice when dealing with a high-risk client. For an airline just emerging from bankruptcy with tight liquidity, this was a devastating blow. The 2022 restructuring, hailed as a success, was therefore not a holistic solution. It solved the problem on the balance sheet by creating a new ticking time bomb in the hangars and on the runways. The maintenance crisis of 2024 and 2025 wasn't an unforeseen event. It was a direct and foreseeable consequence of the very deal that was meant to save the airline. Emerging from the grueling PKPU process, there was a brief glimmer of hope for Garuda Indonesia. With its debt load dramatically lightened and a fresh capital injection of 7.5 trillion rupiah, about $500 million, from the government, the airline managed to post a profit in 2023. To outside observers, it seemed the Great Reset had worked. The flag carrier was back. But the optimism was tragically short-lived. The underlying operational weaknesses, exacerbated by the restructuring, quickly came to the surface. By fiscal year 2024, the airline had plunged back into the red, recording a net loss of nearly $70 million. Its equity turned negative once again, a clear sign of deep financial distress. The comeback was already collapsing. This time, the problem wasn't a lack of demand. The post-pandemic travel boom was in full swing, and passengers were returning. The problem was far more fundamental. The airline couldn't fly its planes. In May 2025, official reports emerged that Garuda and its subsidiary CityLink had a combined 15 aircraft temporarily grounded for heavy maintenance. However, industry data and inside sources painted a much grimmer picture. Aviation data from sites like PlaneSpotters and CH Aviation suggested that the number of parked aircraft was far higher. One report claimed that nearly half of Citylink fleet was grounded, while another indicated that 21 of Garuda's 78 aircraft, over a quarter of its fleet, were out of service for various reasons. The airline was facing an operational paralysis. The cause of this grounding was a perfect storm of internal and external pressures. Globally, the entire aviation industry was grappling with a severe supply chain crunch. The rapid ramp-up of flying after the pandemic had created unprecedented demand for MRO services and spare parts, leading to shortages and long delays. But for Garuda, this global problem was magnified by its own unique history. Years of financial turmoil, culminating in the harsh 2022 restructuring, had destroyed its credibility with suppliers. MRO shops and parts providers, many of whom had been forced to take huge losses during the PKPU process, were now understandably wary. They began demanding cash payment up front for parts and services, cash that a loss-making airline with negative equity simply did not have. The result was a vicious cycle. The airline had routes it could fly and passengers who wanted to buy tickets, but it couldn't generate the necessary revenue because a significant portion of its fleet was stuck on the ground, waiting for repairs it couldn't afford. The solution to the last crisis, drastic cost-cutting and strained supplier relationships, had directly and inevitably caused the next one. This maintenance crisis reveals the true, unsustainable nature of what some analysts call a zombie airline. This is an airline that is kept alive by government bailouts but lacks a viable, self-sustaining commercial model. It is technically alive but commercially dead. To survive from one bailout to the next, it is forced to cannibalize its own operational integrity, deferring critical investments in maintenance and fleet health. This leads to a death spiral. Deferred maintenance causes a decline in operational reliability and aircraft availability. Reduced availability means fewer flights can be operated, which in turn means less revenue is generated. Less revenue makes it even harder to pay for the now critical maintenance that was deferred in the first place. This isn't just a temporary problem that more money can fix. It's a systemic failure state, a direct consequence of being perpetually propped up by the state without a fundamental commercially viable business model. Garuda's story of a struggling, state-owned flag carrier caught in a cycle of crisis and bailout is not unique in Southeast Asia. To understand the risks and potential alternative paths, we can look to its neighbor and regional rival, Malaysia Airlines. In 2014, Malaysia's national carrier was pushed to the brink of collapse. Already struggling financially for years, the airline was struck by the unimaginable twin tragedies of the disappearance of Flight MH370 and the shooting down of Flight MH17 over Ukraine. The devastation and reputational damage were immense. In response, the Malaysian government, through its sovereign wealth fund Khazanah Nasional, took the airline private and launched a massive $1.66 billion restructuring plan called the Mass Recovery Plan, MRP. The approach had similarities to Garuda's later efforts. It involved a painful downsizing, cutting the workforce by nearly a third, about 6,000 employees, and rationalizing its route network to eliminate unprofitable long-haul flights. However, the Malaysian approach also differed in crucial ways. Khazanah, acting with a clear commercial mandate, drove a deep structural overhaul. This included creating a new holding company, Malaysia Aviation Group, to improve transparency and efficiency. It also established a corporate development center to retrain and find new jobs for the thousands of laid-off employees, a compassionate measure aimed at mitigating the social impact of the harsh restructuring. Most innovatively, the airline used a novel legal tool to tackle its biggest cost problem: expensive aircraft leases. Instead of relying solely on local bankruptcy courts, Malaysia Airlines used an English scheme of arrangement, a UK court-based process, to renegotiate its English law-governed lease contracts. This was an unprecedented move for an airline and allowed it to force a deal on lessors, moving all leases to market rates and achieving significant savings. The outcome, while not without its own challenges, stands in contrast to Garuda's perpetual struggle. After its painful and decisive reset, Malaysia Airlines has emerged on a stronger financial footing. While it still faces intense competition, the restructuring was aimed at creating a sustainable, commercially focused business model rather than simply ensuring survival until the next bailout. But does this kind of state-led restructuring truly work in the long run? Some analysts and economists are deeply skeptical. They argue that repeated state intervention and bailouts don't fix airlines. They create zombie airlines. These are carriers that are commercially dead but are kept artificially alive by the state. They cannot compete effectively on their own. They lack the capital to invest for the future, and they survive only because the government considers them too important or too politically symbolic to be allowed to fail. The risk is that these zombie airlines become a permanent drain on public funds. They distort the aviation market by operating with an unfair advantage, undercutting healthier, more efficient private competitors who don't have a government backstop. This prevents the natural market process of creative destruction, where failing companies are replaced by more innovative and efficient ones. For Indonesia, the question is whether propping up Garuda indefinitely is preventing the rise of a more stable and truly competitive national aviation sector. The Malaysia Airlines case provides a crucial counter-narrative. It suggests that a brutal, decisive, and commercially focused restructuring led by a state fund with a clear mandate like Khazanah can potentially break the cycle of crisis. Khazanah's plan was a 5-year, top-to-bottom overhaul, not just a financial patch-up. It used sophisticated legal tools and addressed the human capital side of the equation. Garuda's restructurings, by contrast, have often felt like a series of reactions to immediate crises, frequently driven by political necessity rather than a coherent, long-term commercial vision. The involvement of multiple government ministries and the constant shuffle of politically appointed leadership suggest a far less disciplined and more convoluted process. This comparison highlights the central risk for Garuda as it enters its next chapter. Is its new benefactor, the sovereign wealth fund Danantara, structured to be more like the commercially minded Khazanah, with the power and independence to enforce painful but necessary changes? Or is it just another vehicle for state-directed capital, destined to pour more money into the same flawed structure, ensuring the cycle continues? This question hangs over the airline's latest and perhaps final attempt at a comeback. Which brings us to June 2025 and the latest dramatic chapter in the Garuda saga. With the airline once again on the brink, crippled by its maintenance crisis and bleeding cash, a new player has entered the scene: Danantara, Indonesia's new and ambitious sovereign wealth fund. Modelled on successful funds like Singapore's Temasek and Malaysia's Khazanah, Danantara was launched by President Prabowo Subianto's administration as a key vehicle for economic reform, tasked with professionally managing and transforming Indonesia's vast portfolio of state-owned enterprises. And one of its first major actions has been to intervene in the endless crisis at Garuda. In a move announced on June 24, 2025, Danantara extended a $405 million shareholder loan to the ailing airline. The mission for this initial cash injection is clear and specific: to tackle the maintenance crisis head-on. The funds are earmarked for maintenance, repair, and overhaul (MRO) activities, with the explicit goal of getting Garuda's and Citylink's grounded fleets back in the air and generating revenue again. Danantara's leadership has been keen to signal that this is not just another bailout. The fund's chief operating officer, Donny Oscaria, promised a new approach, one that is professional, measured, and prioritizes good governance. He stated that Danantara is not merely providing a handout, but is acting as an engaged shareholder with a clear mandate to drive a comprehensive transformation. The total support package is projected to be worth around $1 billion, encompassing business optimization and long-term financing. And so, the cycle of the Garuda saga turns once more, with a familiar rhythm: a grand ambition, the quantum leap, prioritized prestige over profit, leading to a financial crisis. Systemic, deep-seated corruption hollowed out the company from within, making that crisis deeper and more difficult to solve. A massive, court-ordered restructuring in 2022 solved the immediate debt problem, but in its harshness, it created a new, crippling operational one. And that operational crisis, the grounding of its fleet, has now triggered the latest state-funded rescue. The ultimate question now is whether this time is truly different. Can Danantara, a new institution armed with a professional mandate and significant capital, succeed where decades of direct government intervention have failed? Will it have the political independence and commercial discipline to force the deep, structural changes needed to make Garuda a genuinely profitable and sustainable airline? This would mean resisting the temptation to pursue unprofitable, prestige routes, ensuring a fleet composition based on economics rather than politics, and installing a management team free from political interference and held to strict performance targets. Or will the immense political gravity of a national flag carrier, a powerful symbol of national identity and pride, prove too strong? Will Danantara, despite its best intentions, be pulled back into the old habits of prioritizing survival over sustainability, becoming just another source of capital to keep the zombie airline flying until its next inevitable crisis? After 75 years of turbulent history, Garuda Indonesia is embarking on yet another comprehensive transformation. The airline is now targeting a fleet of 120 aircraft within 5 years and a return to profitability by 2026. The world is watching to see if this is finally the flight that reaches its destination, or just another holding pattern in an endless, heartbreaking struggle.